The big time stuff that I wish I had. The big time stuff that'll make you mad. The big time stuff. I like the big time stuff. I like the big time stuff that I never had.
Neal, Mody.
What a way to start the episode. Hey, Chris, why don't you record our intro today and explain what the job of our podcast is as part of that?
Record our intro and explain what the job of our podcast is?
Yeah, why are we doing this? Just explain it.
Well, I'm doing this to learn, to open my mind, to... so, anyway...
Come on, do it as a we thing, right? Not a...
Yes. So, welcome everyone to the Market Meditations podcast featuring Neal Mody and Chris Haydel, two guys who are trying to figure this world out, especially when things are changing as astonishingly fast as they are today. Keeping an open mind and asking questions and really looking through the veil of monetary policy and the way things appear to try to find deeper truths. That's what I'm doing. How about you, Neal?
I thought about it differently, but with the same words. With different words with the same meaning.
I'm going to say that to my wife next time we have an argument. I was thinking just that with different words.
And that's a tip you can take home to be a better human being. That will also make you a better investor. What to say to your wife to avoid the argument.
Yes. And I guess you're right. The ultimate goal is to become a better investor and a better person.
Right. Yes. I think becoming a better person makes you a better investor.
Yes.
One of the things I've learned from you, and I've learned over the years, because as you remember, you knew me before I started investing in any real company. I guess I'd done some angel investments, but was a lot about process. I was thinking about how some of the questions I ask you have been very tough to answer because, your process is always evolving. The amount of information you're reading is changing your newest conclusions. And I'm kind of wondering a little bit if you could start to share a little bit of your value thesis out loud. Because I think we should probably explore the evolution of a thesis a little more on our podcasts.
Yeah. Well, there are many ways to approach value, obviously, right? Some of the parts, I think I'm still learning, Neal.
I have no doubt about that. This is the path of mastery. This is not expert.
Yeah. Always trying to take an uncritical eye to what value is. I used to have, I guess I've grown out of being what I used to call concrete bound, where we really, my focus was looking for, beaten down companies, names that were clearly in value territory. The old Ben Graham style of investing in nets, where companies are trading below the value of cash they had on the balance sheet. By the way, those might come back. So
yeah, good old Ben's gonna make a revisit to your portfolio for sure.
Yeah. Those are good, safe ways to invest. But venturing out more is a challenge for the imagination. How do you see value? How do you assess value? I mean, this is something too I'm learning from you, Neal. With the way you've thought about patent portfolios, intellectual property, and other applications of the same technology to unlock value has been really something I've tried to borrow and a template to overlay onto the public securities markets as well.
Wow, I don't even know what to say. What do you? Can you give any example of that? Even though I'm just trying to get to more of the essence of your thesis. Just to validate me, could you get to an example of how you've overlaid a little bit of, the Zoic methodology or my methodology here?
Well, one way, which is kind of a combination of the two, is looking at the dramatic improvements in the oil drilling industry with fracking, directional drilling, and all of those advances that led the U.S. to become the #1 oil producer in 2018 over Saudi Arabia and Russia, two very low-cost producers. And I'm not saying the shale patch is the lowest cost of production, but it was truly unimaginable 10 years ago how much of that resource, oil and natural gas liquids and solids, would be released and produced in the U.S. When we had been thought to be well past our peak. But anyway, I've been, because of central bank policies around the world, pretty much bullish on precious metals. And about 7 years ago or so, we started to see the application of those technologies, directional drilling, et cetera, to core samples and to making the mining industry much more productive and lower cost. And I thought that was a huge bullish signal. So that was the, kind of way of taking an application in one space and seeing how it would affect industries in other areas, in this case mining, from oil drilling and production and exploration into something, closely related geologically, but very different. And the effect that would have on cost and cash flows was tremendous, and still is. The mining industry is reaping the benefits of those advances. So it's kind of looking under the hood. It's one example of seeing something going forward. And of course, the gold mining industry reported record cash flows last year, generally speaking, at a lower realized gold price than we're seeing this year. So there's bullishness built into that thesis as well.
So you are looking, okay, that's interesting. So you are, you're looking, okay, that makes more sense to me about how you're applying for it. It's not like you're trying to apply it the exact way we are, but it's giving you another vector in which to analyze.
Yeah, that's right. That's right.
Could you, and it's okay if you're not comfortable, but can you try and start to share the essence of your thesis? Because I know you look at so many things. So like, how does a value investor like you look at things to say, other than, it's got a good balance sheet and there's a dislocation in the price, and I followed the management for a while and I read all the footnotes. Other than that stuff and the fact that you're reading a lot, could you share part of your philosophy in a crystallized thought, or is it not able to be done?
Yeah, I don't know if I can share it in simple soundbite format. It's a little bit of all of those things. And to each of the outcomes, I'll attach a certain level of confidence to it. I guess, I don't know, Neal. Right now, things are in such a dislocated state that there's a tremendous amount of value. This is generational, epical in certain ways. And we're seeing it in especially a lot of old line industries. I mentioned oil and gas before, but not in this context of being deeply undervalued. Now, the whole energy sector of the S&P 500 index is at around 2.7% of the index. It's never been a smaller percentage because the values of all the oil and gas producers and exploration companies has sunk to such a low level, as if they're forgotten. And this is a not unimportant area of the economy. This is a backbone still of our energy grid. Over 64% or so of the energy we produce is from hydrocarbons. So if you want the lights to come on, you're part of that. If you want the computer to work, so I see that as just really compelling value. is just one example. And I don't know that there's much to talk about except that it does align with other things like the strength of the underlying companies, their balance sheets, the and of course ultimately price, right?
Right.
Price is really the most important part of the due diligence.
Can I retry and sum up your, I guess, your model, if not your, since I can't summarize your thesis? It's a phenomenal historical understanding of what happened in the marketplaces. You're always adding to it, but you've got a really good recall and working understanding of history and the economics in history.
Yeah.
It's a keen study of human nature. It's a lot of specific research, right? So there's no shortcut to choosing for you whether you're going to buy Chevron. It doesn't matter what the price did. If you're going to buy Chevron, it's going to include, a lot of research.
Yeah. Yeah.
Analysis of all of that research, and then making sure the value matches where you want to hit it. Are there other things kind of we're missing in your model?
No, it's fair. I think what I try to do in terms of process is avoid as much distraction as I can. This is very difficult now. But for example, even looking at dividends or income can create a distraction. We've been looking in the oil patch lately for value-based ideas and undervalued names, and it's just there's so many. But even companies like ExxonMobil, Chevron, of course, have high dividends, and I've found myself being unduly swayed by the income that can be produced, because it's nice to get paid while you wait for your thesis to bear fruit, right? Just sit there in a corner waiting for something to unfold while you can get a stream of income. So but I use that as a sort of microcosm of an example. Looking at a lot of analyst research and reports and other opinions can definitely influence the way you think about a company, even the very price at which it's trading. So when I see something that comes across my screen, I try to really get an assessment of what I think the value inherent in each of the moving parts of the company is, and then assign a price at which I'd be willing to buy it. Lastly, comparing that to the publicly traded price, or setting a target. Yeah.
So you told me that at some point in your practice you think that, and this is a bunch of podcasts ago, there's a chance that 80% of what you buy and sell for your clients could be private. Does that mean you're going to move into like more esoteric asset classes? Are you going to look for more? I remember a text between you, me, and Roger Kumar recently, where I suggested junkyards were probably a good business that might be recession-proof, and I think both of you laughed and agreed it might be an interesting, or salvage yards would be. Are you going to start to buy more of the potential cash flow businesses over time? How do you even start to think about that problem? Because let's say 80% of what you're in today is public markets, right? Is that fair? Or is it higher? 90%?
Yeah, that's fair.
We'll include commodities in that too.
80, yeah, probably about 80%.
So how do you inverse that and still have the same level of success and happiness about coming to work?
I don't know, Neal. That's a question I don't know the answer to. I think it's really about finding the most investable ideas, and with experience, being confident enough and constructive enough to concentrate on the best ideas. So, I'm not trying to run a portfolio where we have 50 names, or even 30 names is a lot. What do I have? Do I have room for my 30th best idea? probably doesn't make the most sense. You want to concentrate on the things you feel the most constructive on and have the highest confidence in.
So, who would you go to out in the world, or where would you start reading in the world if you wanted to start to think about this problem, or the one I started with, which was, thesis evolution for investors? Where is it you begin to explore that idea?
Well, there's so much.
Yeah,
so
I'm just saying,
many.
where do you begin, right? Because the 80-20 inverse is really interesting. That's obviously an evolution of the thesis and your belief about public markets becoming more inefficient is what that tells me.
Yeah. Well, and there's nothing stays the same. The speed at which this market correction occurred and the subsequent recovery from the lows has occurred has been so astonishing. I mean, everything, Neal. I can't even really tell you what happened in February anymore. And here we are just in April. It seems a lifetime ago with all the changes that have happened. But one of the big changes, of course, in the public markets over the last year, and especially more recently, has been this kind of resurgence of value. That seems to argue that there are going to be more candidates. I guess let me say it this way. The opportunity set for investing in the public markets is now growing again pretty rapidly. The opportunity set in the private sphere has always been large, especially since the dot-com bust, where we've seen private equity and venture capital take larger and larger swaths of the investment universe, to the point where companies don't need to IPO in the standard 3 to 4 years that was the old century way of doing things. They can stay private for 10, 12 years indefinitely if they can sustain themselves. And so, I guess it really is, to me, not necessarily about public or private, just finding those best ideas. But the public markets are now serving up some really tremendous values.
So so public markets for now. Okay. I'm curious. Let's just try and answer the question for people who are thinking about their own internal thesis. Just as I think a lot of our audience probably is not other sophisticated investors yet, because we're still early enough in our life cycle that it's probably likely to be our potential LPs and your potential clients, right? And our existing LPs and clients.
Yeah. So you're asking what books should someone read?
No, even just where they should start their own research to come up with their own idea. When I meet a new angel investor and somebody says, "Hey, I want to start investing, what advice do you have?" And I say, come up with a process, come up with a focus, spend the time to really know why in a specific segment, even if that's Bitcoin, something I'm not so bullish on.
Right.
Just make sure you have, an asymmetry of information. Some of that's just constant study. Make sure you're running with other big investors in the space, so you have some idea of what they're doing, and make sure you have a process that you spent a lot of time to think through, and process that you spent a lot of time to think through doesn't happen in a weekend, no matter how great or how many neurons you're going to spend, how great your thinking is, or how many neurons you can spend in that weekend. Meaning that I think even if you could use 80% of the capacity of your brain, I don't think you're going to have all the answers then, or 100% of the capacity. If I asked you over dinner, I think, and we just finished a silent retreat, which is maybe some of the best time to talk to you in the worst, because I don't really want to talk, but.
You want to conserve the energy you've built up.
Yeah,
right?
but I'm always curious in what's in your brain afterwards too. So it's so bittersweet to start talking in the car after a silent retreat with you. You might tell me you were going to read a certain treatise by a certain Buddhist, and I don't have a specific name here. And you might tell me you're going to go read a French economist who gave this some thought in the 1800s. Could you share those names with us and specific suggestions?
Well, among the French economists, Bastiat was one of the greatest, and Jacques Ruff too. In the last century, was Reuff was a wonderful economist. Um, but I'd say, from the standpoint of investing, there are
You forgot the Buddhist treatise for us.
the Buddhist treatise.
Something. I mean, you tell me about these different things you read occasionally, and I kind of feel like they must influence some of your openness, and they seem to.
Yeah, yeah. Well, the among the Buddhist sutras, there are so many great ones, and um, of course, the Heart Sutra, all about letting go. It's a very important one. But in this space, I don't know. I always think of the Manimanakaya Sutra, where the Buddha says, um, "This is like this because that is like that." This, right? Very, very simple. Very simple, like, but penetrating, because everything has its cause and effect, and everything manifests for a reason. And it forces one, if you meditate on that, to look into not the way things appear, but into their causes and conditions, which help things to manifest. Right? I see a lot of fear right now in the world, of course, because we don't know the course that this coronavirus will take. Um, Countries like Singapore that thought they had a handle on it, as we talked about last time, have seen a spike in recurrent cases. So they've had a second wave, and that brings a little bit of fear with it. It seems in some ways we have optimism. We're flattening the curve. So it seems, but will we have another wave? We just don't know. And I think, if we really do look deeply at this, the future is something we manifest. That through our actions, both individually and then ultimately collectively, we bring about. It doesn't just happen. So this is just a talk on mindfulness, I guess, right now, about making sure that we're coordinating our efforts to do our very best to knock this virus out in this case. But when I think about investing, Neal, I think about what are the causes and conditions that led a specific company or an investment idea to reside where it is today. What are the causes and conditions which will signify a change? As Virgil wrote in the Aeneid, many have fallen which were once in honor, and many shall rise that were once fallen, right? So things will change. And I'm always trying to think about that. If I were to think about an investment book that had a great impact on me, of course, the writings of Ben Graham are there. The Intelligent Investor, which Warren Buffett talks about a lot.
That's a tough read.
It is a little
It's-
bit
yeah.
plotting. Yeah. I would say a better book may be The Mind of Wall Street, which was Leon Levy, one of the founders of Oppenheimer
We
Company.
will add that to our show
Wonderful.
notes. Pretty please, Chad.
Yeah, The Mind of Wall Street. It's a fantastic book, a little slim volume. Um, um, Nassim Taleb's, of course, Fooled
Right.
by Randomness, the gem of a book which everyone is familiar with, though his Black Swan seems to take the sales prize. Michael Mauboussin's Think Twice, and just the ways, thinking about the ways in which our perceptions can be mistaken. Thinking you might be wrong, being careful, reviewing, building the right checklists. Fooling ourselves can be some of the easiest work in the world. And as an investor, you have to try very, very hard not to fool yourself
Occasionally.
or want to believe.
Occasionally, right? The richest investors in the world aren't right a lot. They are right at a moment when the market isn't.
Right. But they also also concentrate heavily very often in their very best ideas. I mean, Stan Druckenmiller and George Soros really, in the quantum fund, Jim Rogers, they had one great idea, and that was, shorting the British pound. And boy, they took it to the nth degree. It moved against them, and they held on, but it made them all billionaires and centimillionaires. So that was really one trade, almost like SoftBank in Alibaba.
Yeah, the profits of a single trade are propagating an
Right.
entire large business, including its follies.
Yeah, exactly right. Exactly right. Exactly right. It could have been the curse of one big success, right? Now there's t-shirt cannoning your money
Oh God!
to
Oh
companies like
God!
WeWork.
That is the best and worst comparison. I'm never quite sure what to think of at a basketball game when people are a lot more excited about the free T-shirt than the team playing on the floor, right? Like, what did we really come here for?
That's right. Yeah. Well, this t-shirt cannon is definitely run by a son. He's blasting that money, and I'm sure you're not surprised at all because you didn't see this coming. That WeWork is not paying on any of their rents.
You know what I was surprised by was Staples this week. I
Yeah,
was very surprised
yeah,
by that.
yeah,
Um,
yeah.
switch gears with me just for a few minutes on the update here. Any specific messages you would give to your clients, your 120 families, about how this week went, just in general, and what is it that they should know from you in under 5 or 10 minutes?
Well, a few things. First, this was a welcome relief rally from some of the lows. I think that it gives us all a sense of pause and the ability to take a breath. Because 2 weeks ago, of course, the market was in full panic mode and there was a liquidity crunch. And it's just really amazing, too, to reflect on how quickly things can change. I mean this, even if we're feeling depressed or lonely or sad, um, we really have to know that those emotions, too, will pass, that the cycles of life will go. And in the same way, we'll get through this crisis and the sun will come out. The economy will be different in certain ways, but it will recover. And what we're able to do now, if we are thoughtful and active, is to invest for that future when the sun comes back out and we're able to gather together again in groups. I was thinking, Neal, I was having a conversation with another analyst, and he's very bullish on the cruise lines. And I couldn't get there. I couldn't.
Did you catch
Imagine
Corona in your thought there?
Yeah. I couldn't imagine with the devastation the cruise ship industry's gone through and just the stories of, being
Again and
aboard a
again
ship
and
with
again and again and again. Yeah.
well, and just the nature of it. I mean, it's probably the worst place you want to be in a sort of pandemic outbreak, right? With shared food service, all the service personnel on the ship. If one of them's infected, I think they all pretty much ride in
Right.
steerage together, then more will be infected. It's just a, you're just a floating petri dish. So, but I also have to recognize that there are certain industries and certain products that have the most loyal following, and cruising is definitely among them. I talked to an accountant friend of mine, and he can't wait to go cruising again. He was thinking of going in May because the deals are so great.
Wow.
And I said to myself, you are suicidal, my friend. But no, he's ready to go as soon as the doors open. It's really, again, a testament to how, um, certain industries have just that loyalty. The old Mazda Miata. I've always thought about this too, like um, soda, right? Warren Buffett's a genius in this, buying Coca-Cola. People do not switch from Coca-Cola. They don't switch toothpaste
Crest, yeah.
either. But right, people take, and those are interesting because it's not the same with beer,
I just want you to know
right?
I switch my toothpaste really regularly.
See, you're in a small minority of people whose some of those habits are hard to change, but beer drinkers versus say soda drinkers regularly change or are willing to experiment and try different beers and craft beers, etc. They don't have the same
I never thought
flavor
about this way, but
affinity
this is how I think about toothpaste. I know this podcast is not about this, but I think there's different flavor
This could be a podcast about
Neal's
toothpaste.
preferences in toothpaste. I actually thought about it as, this is an opportunity to just try something new, and it will teach me something. I may not like the lesson, but it'll teach me something.
Yeah. Well, again, certain habits are hard to dislodge. I mean, timeshare industry too has a very loyal group of timeshare buyers, advocates. So you
I felt like you kind of gave two messages there, but it sounded like there was maybe another two distinct messages you were trying to give.
Well, just that even the misgivings I have about some industries coming back full bore are probably
blinded by bias.
Yeah, exactly. Thank you, Neal. No, that was very helpful. That's true. Right? I mean, I think people are craving community again. This whole idea of Zoom fatigue is hitting now. People are, even psychologists are weighing in that being on a video conference, WebEx or Zoom call is not the same as being together. And so it stimulates certain hormonal and emotional reactions, but they're incomplete. It's like unrequited love. Not like being in the room with someone where you can see their body language, or even, of course, give them a hug or a smile or something that directly impacts them, and you see the response in real flesh and blood human interaction. So, I think Zoom's interesting, right? Speaking of a stock, right? It's zoomed ahead. I think that's something that'll return back to earth when we return to a more normal economy. But the question of will it be a V-shaped, a U-shaped, or L? I don't know.
Well, then it doesn't make sense to try and predict.
But I do know we'll get. Yeah. No, not now in the fog of war. Though I'm surprised, Neal, to hear you finally admit that these predictions, especially in a time like this where we really are flying in a fog, should be postponed.
I think the interesting thing about predictions is some of what I thought, and this is good because we'll lead this into the predictions game next. Some of what I thought about the world was based on lots of predictions, and I think it's gotten me to take a step back and say, how should I actually be looking at things, and does it really matter? Mm-hmm. Right? Most of it doesn't matter. I still find it fun, and I kind of look at our predictions now as a prop bet for helping the Danny Barker Foundation, and we will figure out how people can bet with us and choose to donate if they like on future podcasts.
Yeah.
So if you're done with that section, we can go into the prediction portion if you want.
We can go into the prediction portion. You can drag me kicking and screaming.
Come on, you're starting to enjoy this.
Yes.
You beat a dead horse long enough, it might laugh.
Even the dead horse will move. Right? He'll jump.
So some of these are kind of interesting. We talked a little bit about startup valuations falling before, on the phone and maybe on the podcast, and we talked about percentages. I want to start there. Over the next 24 months, and we'll just make it pretty easy again. Do you think that startup valuations would have fallen less than 50% or more than 50% on average as we read the National Venture Capital Association report a year from now?
24 months. Which valuations?
That's See, that's
startup
seed through,
valuations. Will they?
F, whatever the heck people can raise from venture capital.
Do I think that they will fall by 50% over the next 24 months?
So this is a 24-month prop bet you're making.
And does that mean that when we arrive at 24 months from now, in April of 2020,
we will compare the previous 4 years of data?
Gotcha. So I think, yes, that they will fall and reach a nadir below 50% of current values. But I think there will be a recovery by 2 years.
Oh, I was going to say, so add caveats.
Not
here.
A full recovery.
Okay, so I think there'll be the recovery, which will make it so that they don't actually fall by a total of 50%. I think we're gonna. So I think we're gonna see stuff that's even more bloodied and bruised than that along the way. But I'm gonna say, no, we're not gonna reach 50% when we look at the 24-month average.
So point to point, right? From point A to point B, will it be a 50% decline? No matter what the path
the path, I think, includes some 70% discounts.
Oh, yes. Easily, yes.
So wait, were you with me or you were against me on that bet?
Then I'm with you. I think that the decline at the end of the 2-year window won't be as stark as it's likely to be on the path. So not quite 50%, no. But I still think it'll be lower than today.
You made some predictions about federal bailouts at the end of the last episode. And you said that you thought we'd see up to another $3 billion, so much easier to say than trillion, dollars worth of bailouts. In the next, before December 31st. Do you think that we're going to see above 3.5 or December 31st of 2020, above 3.5 or less than 3.5 from the federal government?
I think we'll see another 2 trillion, under 3 trillion though, from the federal government by December. But I think we'll have even more stimulus next year.
The only reason that gives me pause to even debate it out loud with you is I think Trump will do whatever he can to win the election. And another $1 trillion worth of stimulus, since he effectively or ineffectively controls the Republicans, is not beyond respite at this moment. So I'm going to go over. That's such a fucking crazy bet. Excuse my French on this podcast.
That's advanced.
That's advanced VC talk,
right?
So I'm going to go over just because of the Trump factor.
Gotcha.
Hospital systems before December 31st. So I think you're almost betting on the second wave. Is the average hospital system gonna need more beds? Not add more beds, gonna need more beds. Because they would have been ill prepared for the second wave. And I want to define hospital for you. I'm not talking about rural hospitals. I'm talking about the hospitals that, we would take Santiago to if he got bumped on the chin. Right? Or that would take Rigonca to.
Most of that's now distributed out to outpatient urgent care.
Yeah, I don't trust urgent care, but okay.
Right? They're not all equal. That's true. Not all created equal. I think that the second wave will be more prepared for. I don't think we'll need more beds.
I don't think so. I don't know how to measure this, but do you think the rise of nationalism is going to go? Is nationalism going to go up or down worldwide? I have no way to understand how to measure this. Tanner, maybe you can help us figure that out. But we're going to take a blind bet and let you be the judge on it, or an ill-informed bet. I think nationalism is going to go down as a result of the coronavirus.
I agree. I think Jon Stewart on The Daily Show would always joke that the only time human beings will come together is when we have an alien invasion. And that's when we'll join forces and stop the petty hatred. I think he's right, and I think this qualifies. I think we will come together more, though there might be a countervailing factor in repairing the supply chain, because it's so much of what coronavirus has exposed is that fragility. There will be more onshoring of the supply chain, which kind of is a little nationalistic, I guess. So no, but I still say no. Nationalism's going to retreat.
So Tanner, we're both saying no, but you'll have to come up with the rules around this one. Last kind of question, prediction corner here, or the prediction game, is: do you think we've seen the bottom of the market for the year?
No.
Okay. My follow-up question is: how far away are we from the bottom of the market?
Farther than we were Monday.
You're so helpful on these answers.
No, I would say, again, Neal, the past patterns suggest at least a 50% decline from the peak to trough. So I think we're still 28% or so from any reasonable estimate of a bottom. And again, remember, going into this, there was already a slowdown globally that was taking hold. And in many industries, we were starting to see it. Even in China, there was a dramatic slowdown before COVID. I think that that's what's going to happen.
My instinct agrees with you. I think it's probably a couple months from now when the bottom finally hits. But it's against the logic. And I think this is part of the reason that I love James Andrews' music in the beginning of the podcast, and I love the cover of our podcast. You like that big time stuff, but we're a bunch of Buddhists covered in money for the cover of our logo. I think being an investor is a little bit about trying to understand contradictions within ourselves and within the world. Mm-hmm. But I thought peak fear would be around mid-April for the United States. I think peak fear might have been end of March, beginning of April. I don't know that it's going to get worse.
I think you're right in the general public, and with concerns about the healthcare crisis, which had a very direct effect on the financial markets. But I think the job losses, the ugly numbers, the basic stoppage of the economy is going to keep hitting the numbers going forward. Now, it's possible that I'm wrong. Psychologically, people might just say, well, that was coronavirus. All the managements are going to kitchen sink all their expenses and their bad mergers and their misguided expenditures under the coronavirus headline.
Everybody's had a bad boyfriend or girlfriend. You're a little more wary the next time out. And we will be with coronavirus. That's human nature.
Yeah, but I'm saying, we haven't even begun to peek at the financial numbers, what this has done to earnings.
So you do think it'll take another month or 2 or 3 to actually start to sort through that, and as people see that better, then they may react worse.
Yeah, and again, I think they go together. There's a corollary, right? If we see the rates of infection dropping dramatically, it gives people hope that the economy will recover and return soon, and they can maybe look past.
But at some point, don't we have to pay the piper for all of the overinflated stock prices we've been building for the last 14 years?
Yeah, well, how do we pay the piper, Neal? That's a great question.
Doesn't it have to be a level set again? It seems to me like what goes up must come down, right? And it needs to level back out. Uh-huh. But I don't really know enough about economics to understand what should actually happen versus what is going to happen.
Well, none of us know what is going to happen for sure. I can surmise, though, that this will be a huge inflationary episode. And it's very possible that stock prices, home prices keep going up, except for the value of the dollar, the purchasing power of the dollar, and most other currencies too, along with it, go down. People have asked me why I think that, and I have been thinking about inflation for a long time, even in this deflationary backdrop. But asset prices have inflated for sure. But I think this is a different ballgame. In the last two cycles, the problems were in the financial plumbing. They were in the financial system specifically. This is an external shock. It's a demand shock, a big one. And I think the response of the government, and it might be the right thing, but it's to put money directly in the hands of small business owners and consumers. And I think the previous stimulus has wound up basically trapped in stagnant pools inside the financial system, especially in the form of excess reserves on the balance sheet at the Fed. So they've given money, bailout money, directly to banks in prior crises, and that money's just basically stayed on loan at the reserve, the Federal Reserve, earning interest on excess reserves. So banks they haven't had to do anything. And they certainly have retreated from lending, commercial and industrial loans, even mortgages. The vast majority are now publicly traded companies that are investor sponsored, generating new mortgage lending. So anyway, I would say that because this money is going outside of this new money being created, printed out of thin air, and issued, is going directly into the real economy, not to the financial economy. It's going to be inflationary.
So, I actually predict that this is sort of one of the obvious tipping points to the United States looking a little more like a third world country. I'm kind of curious whether you agree or disagree, and I'll give you some of the data that makes me think some of it. Going to visit my relatives in Kenya as a kid, everybody could afford a driver, right? Because it was so inexpensive.
Mm-hmm.
Everybody had a driver. Suddenly, Uber came out, and they figured out how to have me afford a driver to the airport every time I wanted to go, right? And on demand, right? Truly, that's about the same time it took to get a driver in Kenya if they worked for you. It wasn't so instant.
Right.
10 or 15 minutes, somebody's ready to go.
You're standing on the curb waiting for Randolph to come from the family garage.
Then, in Seattle, the rise of the homeless has been really interesting to watch. It used to be that you could walk down Seattle and it looked like the epitome of like growth and perfection in every corner you looked. Art galleries and tech companies and just a bustling, good economy. Now when I walk down the streets, I see a lot of that same stuff, but I definitely see a lot more eviction notices, and I also see a lot of homeless people. And it tells me that the homeless population's growing, right? And I have read the numbers, the homeless population's growing. We're dealing more poorly with it.
Yeah.
And I wonder if coronavirus isn't a larger tipping point to more people becoming more homeless and us moving more to a third world country.
Yeah.
Some of the features and effects of a third world country, cheap labor.
Yeah, I think inexorably we all move in that direction. I mean, you and I, Neal, are not the first people to have thought of an economy or a country or the growth of a nation in morphological terms, from its birth to adolescence to maturity, decline, and death, kind of in alignment with a human life. And I think, it's been written in history. Every great empire has had its peak and then decline. Some have managed it very stoically, like I have mentioned Japan before. They've been just remarkable the way that the Japanese public has managed the decline, a lot of it is beyond the control of any one person. It's a demographic change. Versus, say, France. But they've always protested on the streets of France, the
and
streets
hopefully
of
they always
Paris.
do.
But yes, I'm with you 100%. Hopefully they'll always bring the tractors out when needed. But the other thing is, I think that ultimately that comes to the U.S. and when is the U.S. past its peak? And I don't know. I mean, there have been predictions about that since time immemorial, since the 1920s with Spengler and the decline of the West. And, the Great Depression brought out a lot of doomsayers and, of course, 2 world wars. But
in today's terms, do you think you'll have a driver for, under $300 to today's dollars, adjusted for 15 years from now? Do you think you're likely to have a driver for, $300 a month?
Well, I think one of the underpinnings of a strong economy, a strong nation, is the soundness of its currency, and we've certainly given that up. So I would agree with you. I think the standard of living in the U.S. is certainly, from here, most likely to decline more rapidly than it has. I don't know what that means for the public response, public policy response. I mean, part of the reason we had a homeless crisis, the genesis of which was in the 1980s when the federal government restricted payments for mental health care. And so a lot of those patients were thrown onto the streets. And that has only grown as we've, eviscerated the manufacturing economy in the U.S., offshored the labor. I think there will be some onshoring of labor, which may support some rise again. I think, too, there will be stimulus packages which have infrastructure bills and work programs to get Americans back to working again. Again, these will be direct payments from the federal government, like the Works Progress Administration was in the 30s. Again, I think these are all inflationary, but ultimately will be balanced somewhat by a more decent standard of living for a lot of Americans. So I don't know, Neal. I guess the decline will be here, but still I think it won't be too abrupt a change. It won't be like Venezuela or Argentina, where you suddenly wake up one day and find out.
So do you think 15 years from now you're likely to have a driver for $300 of today's dollars a month? Okay.
Yes.
Yeah.
Yes.
It's interesting because I actually think oddly, most of the people listening too, or all the people listening, I think our retirement's likely to be better, as in an odd way in terms of quality of life.
Yeah. Well, it's funny because I do like that you mentioned our avatar for the podcast, a Buddha covered in money, and I think it's important to pierce the monetary veil because I think the inexorable rise of production, expansion, the progress basically is to lower cost, right? Lower cost, increase efficiency. That's what progress is. That is a naturally deflationary force. The reason we have inflation is because we have monetary policies, people playing with the money supply that are idiots or don't think through fully what the long-term effects will be of their actions. And of course, it's always.
So do you think we'll see universal basic income in 15 years?
Yes.
50, yes. So I think so too. Interesting. Okay. The VC corner. Let's just go there and spend a couple more minutes, and we'll call it an episode for our loyal audience that we're so grateful for. One of the things I wanted to mention before we go to the VC corner is if you have questions or comments, we're probably not going to read Twitter, knowing us, so please don't tweet us. But drop us a line. You can drop a line to Chad at zoetcapital.com, and he will make sure we have the comments, and we will do our best to answer your questions, as long as they're not specific about stock picks or things like that. But we're happy to, I guess, shoot at ideas that way too. Just keep in mind that we'd love to hear your comments and questions. The VC corner. I'm curious, as you're looking at this, and I saw this really interesting survey recently. As you're looking at this, you're looking at it from an LP's perspective, and you're probably not spending too much time thinking about the startup universe. What do you think the biggest changes other than valuation people are seeing?
What are the biggest changes other than valuation? Well, I think it may be too early to ask that question. I mean, there's so many things that have happened so quickly, like the availability of credit in the system, for example, which again directly impacts valuations. Will that flow of credit remain interrupted? Will investors still suffer from this recency bias because risk happened very quickly, right? Things were going along, and then bam, 2 weeks ago, 3 weeks ago, it didn't seem like it does today.
You sound like Emeril Lagasse with that bam. Please feel free to use that bam more regularly. He's also from New Orleans, right?
It's already trademarked.
He's from New Orleans too, right? Isn't that a thing between you guys?
He's from Massachusetts, but New Orleans is home. He's embraced it like many people have.
I read this survey that I found really interesting, and this was taken 3 weeks ago, that 80% of the founders in this survey, roughly, said that they thought everything would return to normal by the end of April. And 80% of the VCs thought it would take till the end of 2022. There's quite the disconnect in those numbers.
Yeah. And the first number you gave, that end of April group, were surveys of current
public companies. Yeah.
Oh, founders.
Again, it's rough. I think it was like 70%, but 80% of the VCs thought it would take a couple years to recover, which I found just kind of interesting in general, right? Like, how could two groups be so far apart?
Well, maybe they're thinking about different things. Founders want to grow their business or get their business back to running normally. VCs are concerned about funding.
Yeah, I would think so. Well, yeah, VCs are also trying to make sure that the portfolios they have, the portfolio companies they have that are good, that they're making sure they help along, right?
Yeah, because operationally, I think a founder would just want to get back to operating as quickly as possible. And VCs are always thinking of, how to unlock more value in the next round.
This is interesting. You and I definitely have a certain love for a certain company that will remain unmentioned today. Not talking to them, but talking to a lot of founders in the Endless Frontier Labs this last session out of CERN NYU. The question I got was, we've put our fundraising on hold. Do you think we should? And how long do you think we should put it on hold for? We're thinking 6 to 9 months. Maybe we'll restart our fundraising efforts next year. We have enough money to take us through that. What's your advice to those founders? Seeing a larger picture than I think I do and they do. What's your advice to the founders that we've invested in together?
Yeah, my advice to them,
whether
in
they should
terms
delay
of
around or go for it right this moment. Clearly, there's going to be rational actors, even in an irrational market, who are going to say, good companies are good.
Yeah. I think it's worth pursuing the funding if you believe in the idea. I think you might have to lower expectations, but I think it's fair to pursue that. Yeah. Yeah, I know a lot of investors are going to be looking for a deal or thinking you might be in some way desperate for that round. So negotiations might be tougher, but I still think you shouldn't delay it. I mean, when do you restart? It's a question clients ask me about, where's the bottom? I don't know where the bottom is. It's impossible to know. That's the day before things rise and don't look back. And who knows whenever that is. But what you can look to is the value inherent in your investment, your product, your
That's my advice.
process.
I don't think you should stop. If you're stopping, you should stop for a week,
Right.
2 weeks, regather, take a look at what things should be and start again. I don't think you should stop at all.
Yeah. Yeah. And it's true that in some cases valuations have changed for real reasons on the ground, But that's the assessment I think you're suggesting people make, and I think they should. Yeah.
What things do you think founders should be doing to make cuts in expenses? Here's what I wonder. If you were at a healthy company before with a healthy morale, is it really bad to ask everybody to take 80% of their salary right now? Just to extend the salary? Just to extend the runway? How bad an idea is that really?
Well, given all the preconditions you mentioned, good morale, I don't know if you'll destroy the morale.
Yeah, but destroy the morale if you run out of money too. There's no more. Just because I've sworn on this podcast, there's no more fucking morale anyway.
Right. That's right. I think you're right, Neal. I think that's a fair ask. The leaders of the companies, of course, have to lead by example, possibly taking larger cuts.
Yeah, but that's probably okay for some of them.
But yeah,
and even just temporarily, even if you buy yourself a couple extra months, that's probably not such a bad thing.
No, I agree with that. And that coming out on the other end of it, you can probably sweeten some of the compensation for your loyal employees, which might make it more palatable.
I don't really actually. It's interesting. I don't really believe in all of the salary surveys I see for startup companies because it's just not what I've experienced. Right? If you go to the largest recruiter in the country, they're going to give you a very different price on what the salaries are than what I typically see. So, do those families have the margin to take that cut? But it's interesting. I think I'll probably write to all of my current companies and make some suggestions about it.
Mm-hmm.
I think that's probably it from the VC corner today in predictions and current events. We were supposed to have Vivian Ming on today, but our dear Vivian could not make the time because we changed it on her. And we are going to have her on next week. And we're pretty excited to have her and spend some time with her. So we hope you'll tune in. Just to remind you, Vivian is a computational neuroscientist, probably one of the top 10 data scientists in the country, if not the world. She's an armchair economist, and she really just spends a lot of time trying to get to the bottom of what's causing the problems she's most interested in. And so I really appreciate her thought. If there's anything you'd like us to ask her, please shoot her a message. I'm sure she'll bring it for us, or shoot Chad at zoiccapital.com an email, and he will also bring it to us. Thanks for joining us today, everybody.
Thank you, everyone.
The big time stuff that I wish I had. The big time stuff that'll make you mad. The big time stuff. I like the big time stuff. I like the big time stuff that I never had.